bring into a ton of deals, and you're kind of indexy, like SV Angel, like it's an index practically. And then when you're later stage, you probably can get more to a smaller size portfolio. When you're A, B guys like us, I think there used to be a rule of thumb, I think, of 15 companies that the VCs would just be like taking 2 board seats in their first bite and so hands-on that 15 was pretty good. If you're investing in kind of de-risked deals, that might be okay. I prefer to have maybe 80% of the dollars going to 15 over a portfolio of 25, 30 type thing. And a lot of this depends on the size of your organization. Another thing worth understanding, a lot of VCs, kind of in ancient times, the thinking was, we're going to take a board seat every time. And that's what we told our LPs. We're ex-McKinsey consultants. Our Harvard, Stanford MBAs are worth more than the Harvard MBA of the founder. They have a lot of self-worth assigned there. And they're going to be very hands-on. They then figure out how many boards can I be on before I have a nervous breakdown and be effective. If you're on 10 boards, that's a minimum 80 board meetings, if not 160. You're supposed to be prepared for each board meeting with a little bit of time and follow up and do your action item promises after them. And when I was a CEO with VCs on my board, I found that the only way to make sure they were prepared was to get them on the phone before. So I would phone one-on-one with everybody. And that's kind of my style. I was on the phone with an LP right on the way in here. Keep everybody informed. A lot of communication in a good marriage, a lot of good communication with your board, no surprises at the board meeting. But if you can only be on 10 boards or 5 boards or 20 boards, then why be on the board of one where you own half of 1% compared to owning 30% of the company? So VCs tend to have a minimum target ownership percentage. So that's good to know when you're raising money. That, a new VC wants to join your board, a question you can ask them is, do you have a target ownership percentage when you invest at this stage, company? The VC might respond to that and say, this woman's very sophisticated and I like her style and she'll be easy to work with and I don't have to, I can put less time into this deal because she seems to know a lot. I find that in ancient times, the VC wanted the whole A for themselves, they wanted a third, and they were taking 2 board seats. Now, it's going to be more syndicated than it may have been in the past, so that they have to be happy with 15%. Now the amount being sold in that round has gone down, so now they got to get cool with owning like 10% or 8%. And each VC is different in their personality and the behavior of what their target ownership percentage is. So that's something to be aware of. We benefit from that by saying we don't have a target ownership percentage. We have different criteria that we have to see in the deal. So we're getting into deals that we wouldn't be able to get in if we wanted 15%. But we get in when we're taking 2%. Okay, I already talked about the importance of the funnel of the importance of deal flow. But if you think about that, if you invest in a fund with 2 people that are running the fund that are not from San Francisco, they've never lived here before, what kind of deal flow can they expect to get? Maybe they've got direct access to one startup that's had an exit that's creating a ton of startups. You need a specific explanation of how you're getting your deal flow. Think of it like you could invest in VC A, or you can invest in VC B. VC A has been around for 20 years, or they've been in the industry for 20 years, and they have all this alumni out of deals they've been involved in as operators. Maybe their operators just turned VCs, but they have the network, and they're getting like 5 fundable good deals that'll be funded by tier 1 VCs like a week. So like the number they're getting over a year is like a pretty awesome funnel of real deals. Anybody can go to Y Combinator, anybody can go to Techstars. That's really discounted to 0 in this conversation. Then VCB is getting like 1 deal a week. So these guys see 5 a week, these guys see 1 a week. And if all is equal in ability to seduce and close and get your money in, you're going to get a better return from the guys with better deal flow than the ones with smaller deal flow. So deal flow is the lifeblood of a VC. And if you're a corporate and your true motivations of being in the asset class is access to information, innovation, insurance against being a blockbuster and getting killed, the guy with better deal flow in the sectors that matter to you is also important. I mean, how do you get deal flow? I mean, I talk about the classic ways that people get deal flow. I mean, we were talking about venture deals and Brad Felt. A lot of people have read that book. Brad is truly a likable person in reality. He's rich enough, he can really be nice and well behaved and adored by many people, and he blogs a lot. So he's made a bit of a name for himself by investing time into it, and he truly enjoys it. So he's doing a hobby that he enjoys that's symbiotic with his job. You know, some people, I say, like, blog their balls off, and it just starts to be like, too much for me, of everybody trying to have an ego in that space. So I think that, there's books, there's blogging, there's doing what I'm doing today, and public speaking, and getting video stuff out on the web, and speaking on lots of events. Typically VCs are on 3 or 4 panels a week. So there's a bit of an evening commitment to someone in the organization to be waving the flag. Getting on TV. I think the best way to get deal flow is to make investments into companies, add enormous value to the company, and have those people tell their friends in the ecosystem how great you were. Another way that's like probably where most of our deal flow comes is from other VCs. With the way my life has progressed and that of my partners, we've got great relationships with existing VCs. When I meet a new guy like Ilya, I want to go out to lunch with you and find out what you're looking at. I'll show you my deals and see if you want to invest in any of them. You'd have to demonstrate that you can add value because they're all always going to be probably oversubscribed. Some are going to be hurting and more open, but it's getting to know people and knowing what your secret powers are to add value to a deal. And knowing, different people in the market, like your turnaround situation. I have a company in mind right there that, we want to make a lot of money. We think we got a buyer. Maybe it's better to do a quick turnaround and then 10x it on top of that. Whereas there's other guys that just want to invest in success, success, success. So getting to know the whole network of VCs and getting to know the whole network of entrepreneurs is, in my view, the real way to source your deal flow. And blogging your balls off is sort of bullshit, But I do it. I spent time on blogging something on Saturday morning where I could have been playing lacrosse with my kids. So I do it too. And that fits a bit of what's your brand. I think VCs should take some soul searching, just like any startup, and say, what's our pitch? What is our pitch? How are we different? Why should there be a seat at the table for us? Figure that out and begin to articulate it with some skill. Showing up with a suitcase full of money from China, not enough. Definitely not enough. Again, the post-investment value add is probably the best way to truly generate deal flow. Is if people hear how great you are. I talked about all those different parts of the process of the VC's job. Part of it, too, is behaving yourself and being as cool as Brad Felt along the way, making jokes and having a personality, or being yourself, not being phony. People tend to tune in on not being phony. And how, being hard in the problem but soft in the person. So don't, lose your temper in front of someone and start moaning about information rights like, you're not in control of your emotions. But say, talk to them and explain to them, like, look, I want to know if I should be investing more money or which of my friends to bring in on this. You want to share information, communicate like it's a marriage. So behaving yourself throughout all of these things. So the big moving parts of, of some of this is governance and valuation are kind of two big things. Some people are really big on having, voting rights and some sense of control. I tend to approach it as, if I can add a ton of value and communicate frequently, and then leverage communication from our LP base to the company, that the company will be honest with us to continue the flow of value add. And I don't worry so much about governance as much as persuading them with my understanding of what they should do. And then I kind of stand by the rule of, this is the CEO and I'm an ad-side consultant with a different revenue model. And if the CEO wants to sell the company now, because that's what's happening in his life, well, I hope to be in his next deal or her next deal. And don't try and squeeze the good life out of a good deal. So I think a lot of VCs destroy value more than they add value, despite all their education and pitch of what they do. So if I find myself starting to destroy value at all, that's when I know to step back completely and to say, you know what, I'm just going to go dark on this thing. I disagree, but I'm going to let the guy do whatever he wants to do. All this stuff of adding value and information and trying to keep getting our network to help them helps us make follow-on investment decisions. And I think that the follow-on investment decisions, once you're in a good set of companies, is pretty good. Part of our strategy with our network of VCs is if we have friends that are VCs in Tokyo, like Matsumoto and Switzerland and everywhere, that why should we invest in a deal that failed to attract any other VC? And we're a little bit agnostic on consumer and enterprise within the internet, software, and hardware sector, that if I love a deal and I introduce it to 20 VCs and nobody wants to invest in that with me, then maybe I'm hallucinating and it's not a vision. And if I get the other guys to come in, then the entrepreneur loves me, that like 80% of his investors came through us, you know, and that we have an emotional pro rata that he won't throw me under the bus when I want to make that follow-on investment decision, you know, later. So part of our model is invest with a great VC every time, and that's not going to be your seed investment, but it might be always invest with like we just invested. I think we wired the money this morning to a company where, you know, the founding CEO Mark Pincus is, you know, in that deal with us, and so like, you know, make sure you always have some good names with you, and I think your mathematical statistical probability of getting to a great exit go up. And these guys have big funnels too, so they're probably somewhat price sensitive as we are too, of not overpaying and at risk of the next one being a down round and everybody getting hurt. And by the way, existing investors can get hurt on down rounds. If there's time, I could talk about toxic liquidation preferences and even how to structure how you kill all the other VCs in a round. It wouldn't be something that we would do, but you should at least know that it's happening to you if it's happening to you. Yeah, so the ability to get that information is key. Yeah, you know, I mean, this is nothing. I've now met all of you, and I don't think that this adds value to tell you about AngelList or crowdfunding portals that are out there. I think that we've seen that, pre-selling products is becoming more and more interesting. We invested in a company called Nafty that makes this head-up display, and we invested in them when they were pre-revenue and pre-sales. And then after we invested, it was a $6.5 million financing with most of the money coming from others, but us lucky to be in that round. And then they started pre-selling the product from their website. So they didn't want to share anything with Kickstarter, they just pre-sold it. They had a killer video that, like, I don't know, Crunch Fund goes up with its CPM revenue because everybody keeps watching the video. And so it began this like spiral of the media loves the video, and then so many people see the ad, it's like they were running ads on TV and paying $300 million to run this ad campaign. You know, these guys don't want me to share numbers, but they've been killing it. They pre-sold so many of these things that we raised a $20 million financing for the company just to get through delivering this stuff. And now the valuation for this company has been truly skyrocketing, and it's becoming somewhat of a monster of a company. And yeah, the unrealized gain is crazy high, and you know, everyone's been offered to sell early, so like secondary if you wanted. We didn't, and the company's, you know, kind of on fire. And they still have not shipped a product yet. They were supposed to ship in like March, April. The thing was working when I was looking at it in like May of last year, and then they were supposed to ship by like March of 2015. Then they said, look, we've got so many orders, we need a little time. We're actually raised so much more money, we can make it even cooler and better. We're going to ship in September. Now they say they're going to ship at the end of the year. Might even be later. So they will ship, and it's working. It's working. They just want to, when everyone gets it, they'll be truly delighted. Another one, IoTerra, was they're trying to build a wireless network like they're a Vodafone or a Verizon Wireless that covers 80% of the U.S. population for the Internet of Things. So you know, you want your parking spot to have like a little thing on it that sends information up into the cloud saying I'm free or I'm empty, or do your big data on top of how much I'm free and empty. That you don't want to be stuck paying Verizon Wireless with an actual like cell phone strapped to the floor, or typical GPS tracker. So they're building a network that's designed for this bit stream exchange, and it's meant to be cheap. They're using pet tracking and then just tracking. It's like a Trojan horse application for that. So instead of paying NTT in Japan $60 a year for your pet tracking device, which is as big as a baseball, that you try to hang it on your cat, it's not going to work. And your dog's got to be like a St. Bernard to handle it, and pay $100 for that. They're selling a little base station that you plug into your phone, pairs to your Wi-Fi, and you have an app that does it, and it makes this, you know, between 4 and half a mile radius around your house. So and then you put this tiny tracker on your pet or your crazy husband or whatever it is that you want to track. And whenever it goes anywhere in the radius of your home, you can get it down to the meter all the time. If it leaves your house and hits another zone, it continues to track. They think they only need 11 devices to get like all of San Francisco covered. And they did a pre-selling campaign where they pre-sold 2,000 units. They think they only need 10,000 to cover the whole country. So the pre-selling campaign happened before I invested. And so when I saw that these guys are able to turn up a network cheaper than Sigfox or cheaper than anybody overnight, with consumers actually paying for the network design, the co-location of all the base stations, the power to these devices. If you want to run power up to a church steeple, it's going to hurt on how much it's going to cost. So billions of CapEx, hundreds of millions of OpEx to run a wireless network, and is it fit for IoT? They can run a network at like zero cost and actually make money from the pet tracking, and then get into car tracking and other stuff. But what was interesting to me is that, like, wow, these guys are really using that like toolbox of pre-selling in a way that they show network maps of how much coverage they have of Dallas just on the number of pet owners that have been buying the device, you know? But anyway, so I think that you know, beyond all the different options of how to raise money, that's becoming interesting both from the perspective of the founder and the investor. You know, obviously it's not suitable for every type of company out there. We're seeing more and more of special purpose vehicles, or SPVs, or sidecars. In ancient times, and even today, you'd see a VC fund, classic VC fund with like $250 million fund, like a First Mark Capital. Now the $250 million fund, they probably don't want to put more than 10% of the fund into one deal. I don't know what their rules are, but that's ours. And then one of their companies becomes like BuzzFeed, and it's raising money at huge valuations. They got a pro rata equity right to take a big chunk out of that. That would be too much as a percentage of their fund, maybe outside of the we do A and B rounds or whatever their strategy is. So what they end up doing is they call a subset of their LP investors that put the money into their fund and say, hey, if you move really quickly, I can get you into this later stage pre-IPO phenomenon deal, and I'll get you in and Yuri Milner can't get in. How'd you like to do that? And they call these opportunity funds, and it's a special purpose vehicle, and people just put money into a fund. It's a VC fund to make one investment. And it's something that you're starting to see more and more and more of. And I would say the whole capital markets have adjusted a little bit to accommodate some of this in a world where you don't pay Goldman or even FBR for rushing the public for venture financing and these IPOs we had in 2099, 98. We make heavy use of the SPVs, and I could talk about that a little bit. You know, other options are to invest in a fund of funds. If you can't get an allocation into Greylock and you invest in a fund of funds, the fund of funds will take your money and then they'll get you into Greylock. Most VC funds, imagine you have a $100 million fund and you invested, that's fund one, and you made huge IRR in your top quartile and you got a bunch of great logos in there. And for someone that put $1 million in the fund, they got $3 million back. And now you say, and you even have unrealized gain of some great assets that are worth more that haven't been paid back yet. Well, they put $1 million in, they've received $3 million back, and there's more good news of money to be paid back. You say, do you want to be in fund two? Usually they're going to say, hell to the yeah, I'm going to re-up on that and put at least $1 million into your next fund. If not, say, can I get $3 million into the fund? Or I've been holding back that I really manage a huge family office. Can I put in $15 million? And so the VC who had a $100 million fund, when it's successful, all of a sudden has all of his LPs that he, you know, struggled to get into fund one, looking to re-up, triple up, and, you know, 3x up, 5x up into the next fund. And then their friends are saying, oh, can I get in? My friend was in your first fund. There's a lot of pressure for the fund to get really, really big. And although it's exciting to get a bigger management fee and bigger fund, you know, does first round capital want to manage $1 billion fund? No. So they end up saying no to everybody new, being loyal to the existing LPs. And if any new LP were to come in, they have to like almost commit to invest in the next 10 funds and prove that they can do that. So it's not easy to get into a fund that is performing remotely well. So fund of funds may be your option to get an allocation into this normal world. And you know, the VC fund manager says, if I have a lot of institutional kind of fund of fund type investors, or pension fund of Oregon, which is like $64 billion, and they wish they had more allocation to the well-performing venture asset class, and instead they go into PE because they take bigger checks in hedge funds. You got to prove that you're ready to invest every year again and again and again. If you're an individual who hasn't been investing for 10 years every year in the asset class, it's going to be hard to get into the good ones. So fund of funds are a good option sometimes. If you invest in a fund of funds, expect no interaction with the VC though. And definitely expect no interaction with the portfolio company. So if you're a strategic corporate out of Tokyo looking for access to what's going on in Silicon Valley, this may not be checking that box much at all for you. The other option is to start your own VC fund. And that's kind of what a lot of today has been talking about. Another option is to invest right off the balance sheet, try and network a lot to the startups and to VCs. Or to even do kind of opportunistic SPVs if you think you've got access to the deal flow. And of course, we talked I think a lot about investing in accelerators, demo day, pre-demo day investing, being a mentor to get into the pre-demo day, valuations.
Talk a little bit about syndications.
Sure, syndications like on AngelList.
Yeah, or just what is your opinion about them, or
The AngelList syndications or syndications in general.
I guess the ones on AngelList
Yeah. Oh wow, very good. I'm impressed. You just killed the sound problem in here. Okay, so my understanding of how syndicates work on AngelList. So AngelList, big platform, issuers, startups say, I want to raise money. And then people say, I'll put in this much, often very small amounts. And then you get people that have a big following, like a Twitter following on AngelList. And they say, I'm leading a syndicate on AngelList in accordance with Naval's rules and all that. The terms of these syndicates, which shows the revenue model of AngelList, is that if I have a huge following on AngelList, or let's talk Brad Felt, because I think Brad Felt's a great example of it, with his Foundry Group FG Angel Fund, and then the main fund. What they'll do is they will identify a very early stage pre-seed/seed company and say, we've put in this much from our little fund, or I as an individual, Kelly Purdue in LA, have put in 25K of my own money, and I'm leading a syndicate. Then all of his followers or anybody can put in tiny amounts of money into the syndicate, and it all gets clubbed into an SPV that's automated legally and managed by AngelList. And then the 25K comes in from the individual or the little micro fund like FG Group, Brad Felt, and then whatever amount that came together in the syndicate gets added. It often looks like this. I'm investing 25K, I have an allocation of up to 500K. And so maybe they fill in part or all the 500K, and then the CEO gets 500K plus the 25K in from the syndicate. Brad makes zero management fee on that, but he doesn't care because he's making nice management fee on stacking many Foundry Group funds, and he was doing well before that. And he gets, I think, 15% carry is what he gets on the other syndicated 500K that came through AngelList. So although he gets no money now, if the exit is profitable, they return the 500K first, and then there's a 85-15 split. And I think it actually might be 5%. I think it might be an 80-20 split, and 5 goes to AngelList, 15 goes to the syndicate leader. So we might as well do this now. The normal classic vanilla revenue model for a VC is they get 2% annual management fee and 20% carried interest, or carry. And so that means if you and I, Catherine, founded a VC fund together, we raised $100 million from family offices, pension funds, angels, whatever, that every year we would draw down $2 million, 2% of the 100, to pay for our salaries and operating expenses and lawyers and whatever we're doing. And so that would be 2, 4, 6, 8, 10% of the 100 million went to pay for the expenses of running a high quality VC fund in the first 5 years. And then it's usually a 10-year term that can extend to 11 or 12 years. And usually the annual management fee by year 6 starts to come down. And there's different complicated ways they do it. In our fund, it goes down by 10% compoundedly, starting in year 6. So by year 10, or if we extend to 12, the management fee is like barely covering the cost of the accounting and developing, generating the K1s. But we hope that we're stacking funds, that we're raising a new fund every 2 or 3 years, so whatever. The other ones start to offload expenses onto the startup. They're saying, hey, I charge the startup $25K a year per board seat. And I think that's making it harder to get into the deal when you start doing stuff like that. But other VCs have other metrics of like, we charge 2% on the undeployed capital or 2% on the deployed capital. Bottom line, it starts to go down. So net, if it's 2, 4, 6, 8, 10% of the fund gone after 5 years, some will actually take a clean 20% out for management fee. But when the exits come, all the money goes back to the investors until they've been made whole. So if, of the 100, if we put 80 million to work and 20 million for management fee, and we return the first 100 to our LPs, we basically took a loan on the 20 million and paid it back. So we reimburse the LP for the management fee in a way. And if you came down, it might be blended as 15% of the fund was paid out into management fee, and 85% of the fund was put to work, to get into carry. So once you've paid the fund back, some have a hurdle rate, just like we had the structured deal of you pay 1x back in liquidation preference or 1.2 back. You sometimes have a hurdle rate. It's more suitable for private equity, in my opinion, than it is for venture. But some venture funds, especially out of Israel and stuff, are like offering you a discount on the management fee and offering you a hurdle rate to make it easier for them to raise the money. I think when you bring the management fee down lower, it becomes hard to pay the salaries to build a team and retain a team of talent to actually do the work. So that's what 2 and 20 means in the context of venture capital. 20% of the profit going to the general partner, the guys doing the work at the VC fund, and 80% of the profit going to the LPs, limited partner investors, after the fund's been paid back. So on the syndicate, back to your question, in the context of how normal VC works, some VCs go, where's the management fee? I really enjoyed the $2 million a year, so does my wife. And so if I start doing a lot of syndicates, I got no management fee, and 15%, and I'm giving 5% to the platform, or 5 points, 25% of the real game to the platform, as opposed to me keeping 20%, that might rub me the wrong way if I'm Sequoia. If you're Brad Feld, or if you're Kelly Purdue in LA, they're thinking, yo, this is good stuff because I've raised all the fund I could get, so I actually tapped out what I can get on management fee with my own running around to Abu Dhabi and Japan and wherever. And this is just additional money, and I'm throwing it at the earliest seed. So what's the management fee on a 500K, 525K check anyway? Nothing compared to my new $350 million fund. So I'm not worried about giving up management fee, right? I actually don't care at all. And if I can get more equity upside for being in Uber when it was at $6 billion with other people's money that I don't even ever have to meet or know, word up, I like that. So the syndicate thing works really well for a guy who's got a real bucket of money, who wants to develop that optionality thing. He's putting the minimum amount it takes to sucker, I don't want to say sucker, but to entice others to invest with him into deals. And now he's extending outside of his fund to have optionality dynamics with other people's money that he never met. And so all that blogging your balls off is starting to pay off. So that's my understanding of what's happening with the syndicates. I have other friends that are getting good syndication following on AngelList and like doing deals. They've made some exits, so they got a bit of cult of personality, and then they think they're going to raise a fund on the back of their success. So their fund one is just a ton of syndicates. Another thing worth considering for the syndicate leader, like a Brad or a Kelly Purdue, is that it's deal by deal carry. Normally a VC fund like mine invests in like 25 deals, and if you've got a Google in there and it's a huge exit, you got to pay all the VCs, all the LPs back first before you get 20% of the profit, right? If you made 25 investments and you did a syndicate on AngelList for every one of them, and then now at the seed level, you manage to get 500,000 of other people's money into it, and then you pay back that 500K, and now you've got 20% or 15% clean of the profit on that deal isolated, not weighted down by any of the other guys taking their time to get to exit or just straight up losers. So deal by deal carry is a very exciting concept in the venture capital world. In parts of the world like Europe, where there's a lot of VC and it never gets into carry, deal by deal carry would be really awesome for those guys because they never make anything past the management fee unless they're one of the very few Europeans that get into carry. So deal by deal carry is an interesting dynamic of the angel list syndicate. Okay. Ladder to liquidity, we kind of talked about it. When I at one point had a $1.2 billion valuation for my startup and never made any money off of it. If I'd managed to take like my 300 million paper valuation and like sell 10% of it for 30 million in cash before turning 30, that would have been great. And unfortunately, it did not happen because it wasn't possible. In fact, I even signed for an 18-month lockup where these bankers from Morgan Stanley, very perverted and twisted, they never knew anything about the company. They just arrived at the last minute and they're going to be buying like, brownstones in Brooklyn Heights, and I'm sitting here locked up while the public market is going to have an economic downturn. Crazy. But that's just the way it was back then. The world has changed, and there's now an active secondary market with almost every financing of a good company. Maybe not so much in biotech, but if you get a company like Navdi, where it looks like they're going to be making hundreds of millions in revenue, there's probably someone willing to buy you out from the next financing round or among the existing investors, or even going out to that third party and showing it to the board and see if they want to ROFR it. Who cares if you get ROFRed or not? You're going to get paid. So if you want to sell shares at any step of the way, once the company is super hot, you can do that. So I don't want to repeat. I think we really kind of went through that. But when the IPO window shut, the only real path to liquidity for founders and investors was selling the company in its entirety in an M&A trade sale transaction. That, the IPO window then kind of opened up. We started getting a string of good tech IPOs in the United States. And then, China's been killing it in its own way for a long time as a parallel separate universe. But now we're seeing the IPO market continues, but why go through that pain when you can achieve all your objectives with a private IPO market? So with a mix of M&A, true IPO, and then mega financings where some founders, employees, and investors are selling, that's a new normal. If someone says like, oh, Rubicon, you shouldn't sell at $1 billion valuation in some deal, if we're selling 10% or 20% of our position, I'm like, look, Peter Thiel was selling ahead of the IPO of Facebook. I think if he's selling before the IPO of Facebook, there's nothing wrong with us selling a little bit when we hit to $1 billion valuation. And with our model, we can even make the SPV that buys out that position. So it's kind of interesting how you can create vehicles to invest along the way, and you can be getting liquidity as it makes sense. So although the new investor, like from Qatar, putting 1.5 billion into Uber, has a senior liquidation preference, they get their money out before anybody else, of that 1.5 billion, there was plenty of liquidity for anybody who wanted it, even right there. So it's sort of interesting that nobody can sell ahead of these guys, and yet everybody and anybody can sell at the time of closing that round. I think a new normal is that when your company gets to a $250 million valuation, and you personally as the founder have never had a big exit, I think it's absolutely rational to consider selling 20% of whatever your position is on each major uptick of valuation. And if it becomes like a Palantir where it's on fire, you might even consider selling something, maybe not 20, sell something every 6 months. It's as if you're publicly traded, basically. I met Ted Turner at his house when he was with Jane Fonda. Jane Fonda was gorgeous. And he said, I got 100% of my whole net worth in Time Warner. And I was like, very unimpressed. I think it's stupid to be that concentrated in one deal. I think it makes sense to be diversified. That's just me. I wish I could have diversified when I was in my 20s. So there's a very evolving secondary market for LPs. If you invest in a VC fund and you're thinking, oh, boo-hoo, I can't be tied up for 12 years in one vehicle. That's why I like my hedge funds. Matsumoto-san, our investor from Tokyo, he'll buy you out. You might not like the price he's offering you, but there's a lot of direct secondary funds that exist to buy out LP positions. When right before the IPO of Facebook, I was getting phone calls from LPs in Excel number 9, which was the biggest shareholder of Facebook, asking if I wanted to buy or knew somebody that wanted to buy out their LP position in Fund 9 of Excel. They were thinking, I'm not sure if it's really going to get out at 100 billion. I'm happy if it's less. So there's a burgeoning market to get liquidity, even when you invest in an illiquid asset of a VC fund. There is liquidity in some hot winning deals. For sure, when you see these unicorn guys, anybody can get liquidity in them. And if you want to buy into them, you can even buy off the person who's already bought and not gotten ROFR'd and then sell it. So there's a lot of people in Chicago dealing with startups over here that is just being traded, on that secondary market. Okay, we already completely killed this one on 2 and 20 dynamics. It's good to understand that. One thing to say here on the corporate venture capital side, a lot of CVCs, corporate venture capital like Intel Capital or something, they're investing the money right off the balance sheet. They do not have a GP-LP structure where they become a limited partner and the general partner who runs the fund gets that 20%, 2% carry, that the corporates are investing right off the balance sheet. And I actually gave a talk here which was filmed and it's like on the web you can look at, where I go through a lot of the issues, and a big part of this is the compensation. So a lot of guys will get the job of running this 100 million a year or whatever corporate VC, and they're doing deals right alongside with 2 and 20 guys like me. And after a while, when the exits come, they don't get any kind of bonus, and we do. And they start to think, maybe I should leave the CVC and join a VC where I get paid 2 and 20. And it becomes an issue to retain the talent or even attract initial talent to run the CVCs. And so you do see some CVCs set up with GP LP structures, or like SAP starts off as investing off the balance sheet, then SAP Ventures gets one LP, which is SAP, then they diversify to not risk SAP not wanting to re-up and they might discontinue the program, and they spin off and call themselves Sapphire Ventures and say, and SAP is losing the optics into the innovation, or maybe they still get it, but things evolve. I think both for the LP and for the GP, that in my short 20 years, I had a bad economic downturn that killed me in '01 and a heavy one in 2008. It seems like a fact and a certainty that economic downturns come at least every 10 or 12 years, if not every 5. And so you should be positioned to do well in that context. So, real fast, going back to the first slide on stages, I think that pre-seed, if an economic downturn hits us at some point, pre-seed might argue that by the time their companies exit, we would have climbed out of it happily and we're fine. But a lot of those babies might lose access to new funding because of the generally, whenever I've seen the economic downturn, VCs that were doing early stage start saying, we like to see even EBITDA, or we want to see more revenue and more de-risking of the deal. That 1x liquidation preference means we at least get our money back 1x, and this early pre-revenue stuff looks like we could lose it all. Vintage 2000 Los Angeles was the worst VC asset class in all history. They actually lost everything. They didn't get anything back. Incredible. How can you invest in 15 companies and lose everything? Ask them. They did it. But I think that with an economic downturn, pre-seed is dangerous because those startups could get cut off to additional funding. They'll argue that they'll make it, but I say it's very early. I think seed and later stage seed itself might be a little bit of that risk. Later stage seed is kind of what A used to be. I think that, if anything, a market correction, even a partial one, which may have, partial market corrections already kind of come. We're seeing these, for the same stage company, them going from 10 back down to 3 and 5 million pre or caps. That it'd be nice to see the valuations come down a bit to make it easier for that company to go up in valuation, and we'll get better cash multiples and better IRRs. So I think for the later stage seed, A and B, a downturn could almost be a good thing in that we can exit at higher multiples because we enter at lower valuations. On the other hand, the window may shut for our ability to be doing all this, I sell 20% every couple months because the boom market starts to go away. I think those later stage guys will, at a minimum, have to wait longer to grow into those valuations. Right now, they're saying, with all the structuring, if I get my money back 1x, 1.2x, they have to grow into that valuation of Uber. And when they all convert to one class of shares, and you're not the privileged guy, they really have to grow into that valuation. And that was a spicy valuation to begin with. That they're going to have to wait longer, and they may not be able to raise new funds, or they may find that that valuation was pretty whack to begin with And the companies actually got hooked on the crack cocaine of all that funding, and their spending got out of control, and they were burning so much cash that they didn't correct fast enough when the downturn comes, and that they actually are at risk of being Los Angeles vintage 2000. So I think there's some risk for the really later stage growth with an economic downturn, and the safest part is where I see ourselves positioned. Maybe I've just convinced myself of this and I'm delusional, but that's kind of my thinking. So all of this with a ebb and flow of the economy makes me think if you're an LP investing in funds, don't have a strategy to play big now and then see how that goes, and if it goes well, invest more. I guarantee you that's not a mathematically secure way of doing it. The mathematically logical, secure way of doing it, which takes into context the last 30 years, would be to say, I'm going to invest significantly at least every 2 years. And perfection would be investing every year. Do you have access to great deals to do that? It's great VCs to get in every 2 years. They're not raising every year. But that's the answer, is to deploy capital as consistently as possible over a 10-year cycle. And you may find some of your funds don't return all the money, and some make up for it. And on a blended rate, you're doing well. And if you're corporate, and you think of some of this as R&D money, that you're outsourcing your R&D by investing in biotech VCs, or you're outsourcing your R&D to invest in VC funds like mine, they give you access to information that within 3 years, that should start paying back. And it should be profitable to the tune of at least 35%, that you're then recycling the same money back as you're re-upping into the next funds. So within like 5 years, you should have a zero cost R&D going with access to all that good information that buys you insurance and puts your ear to the ground of what's happening in Israel, Silicon Valley, blah, blah, blah. And for the VC, deal by deal carry, we're talking about what a beautiful thing that is with the syndicates on AngelList. Now you're getting some diversification yourself as the general partner, as the GP, the VC. So VC general partner, like I'm a general partner at my fund, so I'm a GP. So I start getting diversification via vintage of fund. My 2000 fund, my 2003, my 2005, my 2007. And then you're stacking fees as well. So when your fees are going down by year 12, you got plenty of money to run a good shop. We're supposed to do lunch at 12? All right, so what are your top objectives? I think this is a little bit of soul searching, strategy 101. If you're an investor, what are you truly seeking to do? It could be a very simple answer to that question, that my objective is to make a financial return. And I've decided hedge funds are a compensation plan masquerading as an asset class, and I want to put more money into venture capital. Maybe that's it, but maybe it's not. I mean, at your company, I'm sure that financial return is part of it, but there's probably other parts to it. Access to innovation is a big one. Outsourcing R&D in a sense is one. Never waking up like Blockbuster getting killed by video streaming and Netflix is one. Like insurance, I'd almost call that. Sometimes when you buy a company, it could beef up and put steroids onto your corp dev platform, so your M&A group. I once saw an interview with John Chambers where he said he was being interviewed early days when Cisco looked tiny and Bell Labs Lucent looked huge. And they said, Mr. Chambers, how do you expect to compete with Bell Labs Lucent when they have 90,000 engineers in New Jersey and you've got under 1,000 engineers here in the Valley? He said, simply, I got the Silicon Valley. I'm an LP in a bunch of funds. We have our own active direct investment program. We'll buy like 10% of a startup early days. If we lose it, it's not going to hurt me as a percentage of my kind of revenue and R&D budget. And they can think of it as a percentage of R&D that becomes zero cost. So there's different objectives of why you're investing. And that for somebody like Cisco, how they could start getting into the innovation hub and hiring good engineers in Israel. Venture capital is a great tool to then turn that over to the corp dev, and they start buying companies. And then with that one company, they then hire a lot more people. And there's people flying back and forth, and then Cisco starts to destroy Lucent and be better, this way. So it's a bit of extending outside of your company and kind of leveraging the universe a little bit about what you're doing. I guess, for angels and individual VCs, you should examine your personal goals. you know, of what you're trying to do. Okay, so I suggest we take a break there, and see what Silicon Valley Innovation Center's got going for us for lunch, and then we can close up on this round and just take the conversations one-on-one for now.